Hey there, Denver homebuyers. Looking to buy a house in the Denver or the surrounding area in the next 12 to 18 months and want to make sure you get the lowest interest rate possible? This video is for you. Hi everybody, my name is Carl Eschenberg and I'm with the Living in Denver team. And on this channel, we help Denver area home buyers and sellers navigate the rapidly changing real estate market here in Colorado, as well as the rest of the country, and put them in a position to win without wasting time or losing money in the process. If you're thinking about buying a house in the next 12 to 18 months in Denver or the surrounding areas, whether you already live here or you're relocating to the area, and you're thinking about interest rates, it's all we hear about in the news, interest rates. This video is going to be very, very helpful. We're going to cover 5 keys to unlocking lower interest rates when you purchase your home. All right, let's just jump right in. We're gonna demystify how to lower your interest rate. So there's 5 primary keys to lowering your interest rate when you buy a property. And in my experience, a lot of people will understand some of these, but they won't understand all of them and how they all interrelate to translate to favorable terms, including interest rate on a mortgage. So the first one obviously is an exceptional credit score. This is one of the first things that people talk about when it comes to lending and mortgages. And an exceptional credit score is going to be anything over 740. So a 620 could get you into a conventional mortgage, which is great. Even for FHA and other mortgage programs, some lenders will go down to 580s. But if you really want to get exceptional terms on the mortgage, as well as the lowest interest rate possible, you want to try to position yourself in the 740 above category. That actually puts you into a premium category from the lender's perspective, and that opens the doors to things like lower interest rates, more favorable terms over the life of the loan. Okay, so a lot of people say, well, that's great. Well, how do I increase my credit score? And there's a few things that you can do, and you could reach out to us anytime. We'd be happy to walk you through this with either a member of our team, or a lending partner. But the 2 main things that you can look at to make the fastest impact is make sure that there's no discrepancies on your credit report, and if they are, handle them immediately. Just get that out of the way so that it's not there when you get ready to apply for your mortgage. A lot of people wait until they apply for the mortgage to pull their credit score, and then they find these things out, and it makes it just even that much harder to get things taken care of. It's not hard to do, it just takes time, and then it also takes time to rescore your credit. Some lenders will do what's called a rapid rescore, and their underwriting department will accept that. Some lenders won't, and that's okay, but you want to get ahead of the curve either way. And then the last thing to do is to make sure that while you're looking at your credit score, make sure that you're maintaining a healthy debt to income ratio. We're going to talk more in detail about that in a second, but in general, try to keep your credit card balances below right around 30% of what your balance is. So if you have an available balance of $10,000 on a credit card, try to keep that balance on that card active, but keep it below that $3,000 mark. That's really going to put you in a healthy position from a DTI perspective. Okay, and that's going to lead us to key number two, optimizing your debt to income ratio. Now this one is, we find, very misunderstood by a lot of folks. When we sit down and talk to them about creditworthiness and things that they can do to get lower rates and more favorable terms, we're just going to walk through a couple of the key issues. Again, you can contact us anytime if you want clarification or if you have questions, but this should help you get a fair idea of what you need to do to make sure that all these things are checked off on your list. So your debt to income ratio that communicates to a lender your ability to manage your existing debts while at the same time being able to accommodate new debts like a mortgage. So they look for typically a DTI, or a debt to income ratio, of under 36%. So much like we were just talking about with the credit cards, paying your credit cards down and keeping those balances but 30% or lower is really an optimum strategy to increasing your score. It also bleeds into your debt to income ratio. Now there's certain things you can't just pay off like right away, like an existing mortgage, car payments, things like that. But if you want to keep that debt to income ratio healthy, you want to keep it below that 36% threshold. So you want to prioritize paying off your high interest debt first. Typically that's going to be credit cards. So we already kind of covered that. And then you want to avoid incurring any new debt to maintain a healthy DTI through the mortgage process. This is really important. I've actually seen people in my career get excited, buy a house, they get all the way to the week of closing. They're at the week of closing. Lenders reserve the right to repull your credit all the way up to and including the day of closing. I saw a situation one time that was really sad. The client bought the house, got to the week of closing. They were so excited about the house, they bought some furniture and they did some other stuff, which is normal, but they took out additional credit to do it. And the big thing they did is they bought a new truck. So they had a brand new truck to park in their brand new garage. The problem is that pushed their debt to income ratio out of bounds with the lender's approval requirements, and they were no longer qualified for the mortgage, which is not the situation you want to get into. So again, prioritize paying off the high interest stuff and then avoid incurring any new debt while you're going through your mortgage process. Number 3, stable employment history. Now this might seem like it's pretty obvious, but we are living in the day of the gig economy. So with things like shift shopping and driving for Uber and all the different things that you can do, all the different work from home opportunities, things have changed in terms of income documentation. So it's not just a simple world where it used to be 1099s and W-2s and that was it. There's a little bit more complexity here. So you want to strive for a minimum of 2 years of consistent employment, documented consistent employment. So that's 2 years of consistent income in the same space, preferably the same sector. So if you're a teacher and you can demonstrate 2 years of employment as a teacher, that's great. If you can demonstrate 5 years of employment as a teacher, that's fantastic. If you demonstrate 2 years as a teacher, then 1 year as a salesperson, then 2 years as an executive assistant, that can be a challenge for lenders when they see that because it shows inconsistency in the type of employment. So not only is it how long have you been employed and how long have you had the track record, it's also what you've been doing. So anyone who's a freelancer or self-employed, great news for us. It used to be really challenging to actually navigate the mortgage landscape when you were getting paid as a freelancer or a self-employed person, and real estate's one of those gigs. So, but today it's a lot easier than it used to be. You will probably be required to provide additional documentation just to prove your income and the stability of that income over time, but it's not that big of a deal. So think in terms of like bank statements, income statements, tax returns, and things like that. As long as you have that stuff available, you'll be good to go. Okay, so we've gone through 3, there's 2 more left, but I just wanted to check in real quick. If you have any questions, you can scan the QR code on your screen or call, or text us, or email us to the information on your screen. We would be happy to answer any questions you have. We are licensed real estate brokers in the state of Colorado, so we love making these videos for educational purposes, and we'd love even more to help you in person and answer any questions on any of the content we provide, or just anything that has to do with real estate, period. All right, let's just jump back in and finish these last 2. Okay, so stable employment history we've already talked about. That's pretty self-explanatory. And then low loan to value ratio. So this is another one of the 5 keys to lower interest rates and favorable mortgage terms. Your loan to value ratio is what it really equates to the lender's risk. So they're giving you the money for the house, right? So you're securing the loan with the asset of the property. If you have no equity in that property, that's a huge risk to the lender. If you've got a 20% equity stake in the property or more, that's a significantly less risk to the lender. And that's the kind of stuff that's going to get them to show favorable treatment. So aiming for an LTV of 80% or lower is kind of the sweet spot. The lower you can go, the better. So a couple things happen with the lower you go. You're going to get lower interest rates, you're going to get more favorable terms, but you're also going to have a lower house payment. So it's a win-win-win all the way around. But this can significantly decrease your interest rate if you pay attention to loan to value ratio. And again, this will save you even more money over the life of the loan because you won't have private mortgage insurance, which is an extra expense tacked on to a lot of mortgages that don't have 20% LTVs. Okay, and then the final thing is a robust credit history. Now we talked about your credit score. This is your credit history. So it's really a panoramic view of your spending habits and your credit habits and just your financial habits in general, right? So one of the first things you want to make sure is that you prioritize a mix of credit type. Now, if you don't have a variety of credit types on your credit score right now, before you go out and get any additional credit, talk to your loan officer, call us, talk to someone who can take a look at that with you and come up with a strategy to maybe improve that mix. If you're looking to buy a house in the next 12 to 18 months, probably not the best idea right now unless you have it looked at by a professional. Just make sure you're dotting your I's and crossing your T's, because if you throw some more credit on your credit score, that can drop your credit age average, and that can have a dramatic impact on your score overall. So prioritizing a mix of credit types, what that means is just make sure that over time your credit report has different things on it: a car payment, some student loans, a mortgage, credit cards, different types of credit types. Show them that you can handle different types of credit responsibly, and they want to see that mixture, that portfolio, if you will, of credit usage. Maintaining a record of on-time payments obviously sounds really, really elementary, but you'd be surprised. People are like, it's okay, I just missed 1 or 2. It can have an effect. You can recover from it, but at the end of the day, they really want to see, obviously, they want to see that you're making your payments on time always, right? So that's one of the biggest things that you can do. And limiting hard inquiries. Now, a lot of people overlook this. I've seen this have negative effect on people in mortgage situations before as well, where they were trying to get a car, then they were applying for credit cards. So they had all these hard inquiries on their credit score. And by the time they got to the lender, it became a problem, because the way the lenders look at this is if you've had all these hard inquiries, they're assuming that you're in the process of getting more credit. So you're taking on more responsibilities, you're taking on more credit, you're taking on more financial obligations, or you're at least looking to do so. So then the question becomes, if you had a hard inquiry from Chase Bank on a credit card, why didn't they give you the credit card? So it turns into one of those things. But if it doesn't, then they're assuming like, well, hey, their debt to income ratio could significantly change if these hard inquiries all turn into new credit accounts. So if you buy a new car and then you have a new credit card with a $20,000 credit limit, and then you take out a personal loan or you buy a boat, all 3 of those things, when they hit your credit report, that's going to dramatically shift both your age and credit right? But it's also going to shift your debt to income ratio, which is, as we talked about, point number 2. That's key number 2. You want to make sure you keep that in check. So limit hard inquiries as much as you can, because that's a negative signal to the lenders. Okay, so if you do these 5 things, these are 5 keys to lower interest rates. Now, interest rates are a hot topic right now. Everyone's talking about it. Seems like that's all we hear about in the news. And we can sit here and compare interest rates to last year, the year before, 5 years ago, or 15 years ago. And at the end of the day, it doesn't really matter. The interest rates are what they are. And if you have to buy a house, you have to buy a house. And the truth is that interest rates come with having a mortgage. I'm not saying that you want to pay the crazy interest rates that we've seen in years gone by, but at the same time, should it be a factor in holding you back from purchasing a property? That's a personal decision that you need to make. But when you make that decision, just understand, if you do these 5 things, you will be positioning yourself to get the most favorable terms and the most favorable interest rates in any market, regardless of where current interest rates are. So it's a super powerful set of tools. I know that this is not by any means an exhaustive report on credit. It's not meant to be that. We don't want that. These are 5 things that we know, if you do them together and you do them right, they will make a huge impact on your total cost of ownership when you purchase your home. If you have any questions or if you need any help, we do have a Denver home buyer's guide that is free. It is packed with information just like this and so much more. You can text Homebuyer to the number on your screen, or just send us a text, use the QR code on your screen. We'll send it to you immediately. It's got information on getting ready for your mortgage. It's got checklists for moving. There's all kinds of additional information in there to help you navigate the complexities of the home purchasing process in the ever-changing Denver real estate market. If you have gotten any value out of this video and you're thinking about buying or selling properties in the near future, we do videos like this every week. So maybe think about subscribing and turning on notifications. That way we can keep you plugged into the most current situations in the Denver real estate market as they happen. You'll be way ahead of everyone else that's looking to buy or sell house here in the Denver metro area. And as I mentioned earlier, we are licensed real estate brokers, so please don't hesitate. You can call, text, email, scan the QR code on your screen. It'll give you direct access to all of our contact information, including our social channels. We would love to help you any way we can. We'll treat you like family, make sure that you're well cared for, and more importantly, put you in the driver's seat so you're empowered to win in this crazy Denver market. Okay, we'll be dropping our next video next week as always, but in the meantime, if you need anything that's real estate related between now and then, my name's Carl Eschenberg, and I'd love to show you around town.